All right, we're going to get started. Can you guys hear me okay in the back? My name's Doug Bryan. I'm the co-founder of Mine. And so on behalf of my partner, Colin, and the rest of our team, we want to welcome you guys. Thank you for coming. This is our first educational event. We're actually quite excited talking about how to enhance profits. So in terms of our objectives for today, we want to introduce ourselves, let you guys know who we are, what we're all about. But the real objective for this event is education. We have some great speakers. Damien and James are both going to be, I think, sharing some valuable insights. Hopefully Colin and I can add a few nuggets as well. So we put together about an hour presentation. James is going to talk about the multifamily market here in the Bay Area. Damien's going to give us more of a national macro view. Colin's going to talk about some exciting new technologies and how those technologies might impact real estate. And I'm going to tell you guys a little bit about the Waypoint Home story, which was our first company that provided some valuable lessons learned. And then also leave you with 3 tips in terms of advancements in technology that I think can help you enhance your returns in 2017. So before we bring James up, I'm just going to give you a little bit more on James. So James is a very busy guy. He's the president of NAI Northern California, also runs an investment firm called Lakeside Company. So he has an interesting perspective, both sitting on the principal side and the broker side. James has been in the market for a long time. In fact, he's been in the market so long that he actually leased Colin and I our first office space for our first company, Waypoint Homes, in his old office building down on Grand Avenue. And 2 weeks ago, James was kind enough to have me come speak at his event. And at that event, I learned something new about James that I did not know. And apparently, he's a very accomplished martial artist. So I just wanted to put that out there in case anybody has any critical comments on his presentation. There's no way out of this space.
Right
so
now, is it a clicker or this?
All right, so this will be pretty brief, but hopefully value-packed. I just want to highlight that at the one of my companies, the brokerage company, does do property management. And I think these guys at Mine do such an amazing job that I had them speak to our clients and actively encouraged some of our multifamily management clients to talk to the people at Mine. So I think they're doing an amazing job. They'll tell you about it later. I'm going to do a little bit on the multifamily market. We'll cover rents and sales. And I know a whole bunch of people in back, so I'm going to try to call on some of you guys when you're least expecting it, maybe right when you take a big bite or a gulp of beer, so be ready for me back there. So a little bit about me. Doug mentioned the brokerage company. We're about 85 people in 3 markets in the Bay Area. We've had great expansion largely because of what you folks all know has happened in the Bay Area, and we'll look at some of those trends. Our investment company is doing our 25th syndication right now. We have averaged more than 25% annual returns, which is relatively unheard of. And I think there are some concrete reasons why we've been able to do that that I'll try to share as well. Where we've been, I think it feels that's probably pretty accurate to how the Bay Area market has felt. We had the dot-com bust. We had a pretty big recession from 2008 to 2011. And I think, contrary to the stock market, that I think is pretty hard to time, I actually think the real estate cycle is not quite as hard to time. And similarly, one of the tenets of my investment company, Lakeside, is that we want to find non-public material information on which to trade real estate, which gets you in prison in the stock market, and is common and achievable and ethical and legal in the real estate market. So I'll talk a little bit about how we've been able to do that with our investments. Before I do that, let's talk a little bit about what's happened more recently. So as you look at cap rates, they spiked, of course, particularly at the end of the recession. And for those of you that are not pros, the cap rate works inversely to price. So prices went way down in 2008 through 2011 timeframe-ish. And you could see that cap rates are sort of at an all-time low. when you switch to price per unit, which for multifamily is a much more level measure of value, you can see that really even through the years where, hey, the laser works, where the cap rates were spiking, we had a little downturn in multifamily, but really not a ton. And as soon as we came out of it, we had a pretty nice steady run. How many multifamily owners do we have in the room? Half-ish, that's great. Okay, a little more. So when we look at rents, this certainly tells part of the story. We've had sort of this nice, gentle upwards trajectory. And if we looked at this across the rest of the country, it'd be very, very different. But I'm staying pretty Bay Area centric. So where are we going to go from here? It's anybody's guess. I think the Trump presidency probably has something to do with people feeling like that. But gosh, we're doing fiscal stimulus in the way of infrastructure work. And now I'm speaking more nationally. We are doing Treasury policy that will result in higher rates, which means monetary contraction. Thinking way back to my Cal econ degree, when you have monetary contraction and fiscal expansion, it's a little bit like partying in Vegas every weekend right after you lost your job. At some point, that party comes to an end as your credit card bills pile up. I'm speaking for a friend, not for me personally. So where might we go? I think something like that probably happens if you look at inventory in the Bay Area, particularly in San Francisco, condo development. There's a pretty big glut. One of the things we watch a lot is venture capital money, and it dried up about a year and a half ago. There was kind of a scary period, and I shouldn't say dried up, but experienced a little bit of a drop. And it seems to be back for the most part, although I would say carefully back. And so, as we look at office space in San Francisco, a bunch came out, sticking more to multifamily. When immigration issues are bad, meaning difficult to immigrate, and when venture capital money is scared and there's a lot of uncertainty, we tend to see fewer renters, supply and demand, a lot of stuff coming online, and fewer jobs and fewer people moving into the area means maybe rents fall. I don't think they fall a ton, but they probably fall. And so what do you do about that? I think rent-controlled markets are still probably a pretty safe play. And I think certainly not panicking is a good idea. When I talk about timing the market, the first thing that comes to mind to me is, how did the Mind logo get up there? That was the first thing that comes to mind for me is track data, because a lot of times when I give this talk, if it's for a room full of people that aren't tracking data carefully in real estate, there are big surprises for them. And so when you take your own property, and Doug was kind enough to show me dashboards that Mind has that show you sort of the pulse of your property management. How do I time the market when I don't actually know what's going on either with the market or my property? I would not just with Mind, but with national research reports from major brokerage companies, places like LoopNet and CoStar. I would watch those trends so that you can at least plan accordingly. You may decide to do nothing, but at least it'll be an informed decision rather than kind of a blind decision. So what else you can do? When I talk about buying properties so that I get consistently exceed market returns, I think the main way we do that is by buying off market, where we know something that other people don't know. And so research, as I touched on, is a key, and enhancing your returns through picking very specialized professionals. So I think of Mind and properties like Mind, they have one mission and one goal. And I think it makes it way easier for them to do an amazing job at that. When I see a seller out there with their property on Craigslist and they're trying to sell a 40-unit apartment building because they were trying to avoid the $500,000 brokerage fee or whatever it is, that's somebody who's a CPA or a dentist who's trying to be a real estate agent by hobby. I think that's a recipe for them to lose money. It's a recipe for my investment company to buy it and make a lot of money. And so similarly with my companies, my brokers don't work in my investment company, and my investment company folks don't work in my brokerage. So if I were all of you, if you own 300 units and your full-time thing is running your multifamily portfolio, you're probably pretty good at it. if you own 10 units and you have a day job, even if it's something smart like tech, I would encourage you to hire third-party professional property managers and interview experts for anything you might do, and I think that will help you to enhance your returns. So in any market, if I go back to the graph of everything bouncing around, right now we're probably fairly heated in the market. I think we have a lot of signs of frothiness that may boil over and they may not, depending on what happens with interest rates and a bunch of other factors. I do think there are good deals in any market, as evidenced by my investment company buying a bunch of properties right now. So I still think there are good properties out there. What will the market end up doing? I think we're near enough to the end that our hold times are lower than usual. And for my investment company, when we take a big dip, which we know we're in a dip because we're watching the statistics very carefully, that's when we'll buy more and that's when we'll hold longer. Let's see. That is my last slide. I had a Q&A, and I know that was very brief on where the Bay Area is going, but maybe a question or two, or else I will call on someone I know or someone I don't know. Tim Warren, question about...
Yeah, I have a question. I mean, obviously working for you, I know more, but I know more about his
Not
past
a plan.
being a multifamily owner, in this market, what would you recommend for the owners? I mean, obviously there's a lot of uncertainty. Would you sell in this market? Would you hold, kind of see where things go?
I would list with you. No, I'm just kidding.
I like it.
So, I think the answer has to be well calibrated, and for full transparency, there are at least two other brokers in the audience here that don't work for me that are really good. So there are a whole bunch of really good professionals out there. I think it has to calibrate to your situation. So, if I was thinking of selling, and I did sell, how many deals have I sold? Maybe 7 deals in the last 12 months, something like that. Mm-hmm. If I were thinking of selling, I'd probably do it now because there's enough risk and enough uncertainty that it's probably worth taking advantage of. I think I would not be shocked if this bull market continues for another 2 to 4 years, and then maybe I sold a little bit early. But if I had a strong reason to sell, I think the risk of a downturn outweighs the probability of a potential reward of the market continuing to explode up. Do we double from here before a correction? Boy, I think it's really unlikely. Some folks in the audience own 3 or 4 buildings. They want to generally do nothing and have very low risk. They've paid off their mortgages. There are reasons I think that strategy is not phenomenal, but I can't argue with the idea of just sitting on it because everything works and there's risk in any transaction. So I guess I'll argue both sides of the coin there. I had another hand go up. Yes.
Where do you see the mortgage rates trending? We had a good bump in the last 5 weeks or 6, whichever they count Trump has taken.
So the question is, where do I see values going? Or
no, the mortgage rates, mortgage interest rates.
Oh, the interest rates.
Like from a bank.
Where do I see them going? I don't try to guess short term. If I were refinancing or acquiring a property, I would attempt to lock my loan relatively as soon as possible. Why? Because I think the probability of rates going down another 150 basis points short term is just not very high. I think the probability of it going up short term is hard to say, but in the next 1 to 4 years, the probability of rates going up, I think it's pretty likely for the reasons I mentioned. There are many other reasons, but certainly the monetary contraction, the fiscal expansion, the whole Vegas party ending thing, I think long term, meaning medium to long term, 2 to 10 years, rates have to go up at least a little bit. Did I answer your question?
Yeah, so in the last downturn, the last 2, if you look at some trends, what has been, for every 1 percentage point of mortgage rate increase, what is the drop in the value of the market? Is it like 2% drop, 5% drop?
Yeah, so I get a lot of questions that are like, what's the magic formula? I think of this much more like a regression model, where I have a certain correlation coefficient but there are all these factors, all these coefficients that are going to go into that R squared, right? So interest rates, what I can tell you overall is interest rates going up, particularly 100, 200 basis points, it will have a dragging effect. However, if interest rates go up right as a whole bunch of, without getting political, probably irresponsible, but a whole bunch of deregulation is happening, that will have an effect on prices that will be upward. So if you give me 150 basis points increase in interest rates, but that happens right as Dodd-Frank goes away and a bunch of other regulatory compliance costs go away, I think that I might end up, equal or even still going up a little bit on pricing. Doug's going to talk about some other technologies. Transparency increases pricing. Knowing data, having good recording, good research increases pricing. So one of the reasons you get crazy multiples in the stock market is that the research is more transparent and therefore the multiples are higher. So I think data, and he'll talk about this, but drones and maybe distributed ledger for, which is not Bitcoin, but it's a Bitcoin technology for deeds, stuff like that will help prices go up. I wandered off on a tangent. Final burning questions, and I'm going to hand it back to Doug. Thanks so much for making it, Doug.
Yeah, thank you very much, James. All right. Thank you, James. That was terrific.
And I'll be around if somebody has questions afterwards. I'm happy to answer them.
So our next speaker is Damian Manolis. Damian is a good friend of mine. He's my neighbor. He's going to come up here and he's going to stand in front of you and seem like a very unassuming guy, and he is, but he has an enormous job. He runs all of U.S. transactions for Prudential Investments. They manage about $65 billion in assets, and they do about $10 billion in transactions every year, and Damian oversees them. So I asked him a favor to come and speak to all of you. I mean, he's got a very interesting macro view of real estate in the real estate in the U.S., and so I think it's a very, very valuable perspective. Damian, really appreciate you coming. Just one request, the slides that Damian's been generous enough to share with us are proprietary to Prudential, so take notes, soak it all in, but we just ask that you not take pictures of the slides.
They're not that earth-shattering, but he had to say that. Thank you, Doug. Well, Doug, he first told me he wanted me to talk about politics and interest rates, which this gentleman already asked about, which are impossible topics, but they are actually the backdrop for a lot of things going on. In terms of bigger picture, and I'll do my best to talk about some things that are relevant to all of you. I work for a real estate investment company that Prudential basically owns, and all the money, even if you've seen Prudential's name all over the place, on the real estate investment side, all the money we invest is money that we've raised from other parties. So we're basically an investment management company. As Doug said, we have about $65 billion globally invested in real estate. We invest in every real estate product type. So that's, I call the main, 4 food groups: multifamily, office, industrial, and retail, but then also hospitality, data centers, medical office, self-storage. So we touch a lot of different things, and we bounce around from year to year. And one of the things I wanted to talk about is why we like multifamily so much, and some of the drivers of that, and why we're spending a lot of time in that space. We have about 1/3 of all our real estate investment activity in the multifamily space. Right now we're invested in about 40,000 units. 20,000 of those units are up and operating. We either bought them as is, or we participate in the development of them. And then we have about 20,000 units right now that are under development in some stage of development. Aside from multifamily, the other sector that we're very bullish on right now is industrial. And all of that is really related to e-commerce. And so we feel like industrial is a big beneficiary of e-commerce, and retail is going to be the loser. And you're seeing that even the last week or so when you saw the JCPenney stores closing. So that's been just going on and on. It's going to continue. Yeah. Thank you. So why do we like multifamily? And these are the main drivers, and I won't worry about all the detail in here. I didn't realize it was going to be so small. Main reason is demographics, and you look at that cohort that's 25 to 34 and how that's growing and how wages have been growing and how a lot of people in that cohort are still living, as we say it, in their basements, family in their parents' basements, but they all are moving along in society and will be renters, and so we see a big bulge there in that demographic. Also in the more senior demographic of people wanting to downsize and be out of home. So these are trends all over the country. Job growth has been quite good in this cycle. I have a couple slides supporting that, but that's our second theme in terms of what's driving multifamily. Household formation, which I already talked about, which is basically people moving out of the family home. Home ownership rate, as you know, it was at a high, maybe 2006 was a big contributor to the housing bust. But that's, now that's kind of bounced around. We have this renter by choice issue. We have the difficulty to get into homes. All of that's having a positive impact on rental. And then supply. Supply is actually, not as bad as you think it is, given all the development that we've had across the country. And it depends market by market, and there's a couple issues impacting supply that we'll talk about. For those of you here, when you think of fundamentals, you're probably thinking of rents, concessions, how long you have units vacant for. And some of those things in the Bay Area have been a little bumpier over the last 18 months. In terms of some of these drivers, employment has been a huge contributor to why we've leased up all these units over the last couple of years in this last cycle. It's also had a positive impact on the office space. Wage growth. As much as you've seen rents increase and you're worried about how can people afford these face rents, I mean, I still find it incredible in the Bay Area for a 1 and 2 bedroom what people are willing to pay. Wages nationally and even in the Bay Area have actually gone up more since 1990 than your rents have. So as much as you think that's an issue, there's actually wage growth to support it. Cap rates have, the 4% cap rate. So someone, you asked about interest rates. We feel like we've been at the bottom, bouncing around with the 4% cap rates. Folks' trajectory in terms of what they are expecting on rent growth is going down. Their projections for vacancy are going up. Projections for concessions are going up. So all this is contributing to these cap rates bouncing at the bottom at 4%. We also probably over the last quarter or two have seen the slowest transactions volume in the multifamily space. It's actually less pronounced than in the other product types than we have seen probably in the prior 4 years. And some of that was election related, some of that was the interest rates that popped up after the election, and some of it's just kind of where we are at the mature point in the cycle. We're expecting we're going to see increases in cap rates partially as a result of interest rates going up. The other thing I would say though about cap rates, I think James mentioned this in terms of all the factors that are impacting pricing. Cap rate is one thing. We always are looking at values as they relate to cost. As I mentioned earlier, about half the activity we have in the multifamily space is development. So we're looking at what in one market it's costing us to develop versus what we can buy existing product for. So despite what your rents look like and despite what interest rates are, if we see a situation that we find is a discount to replacement cost, that's pretty compelling, and then the cap rate in that situation might not even come into play. Developers are very busy. When you're in the Bay Area, you feel like there's so much development here, but if you look, all the markets that have really had a lot of development, and this is measured as the amount of new development as a percent of local stock. It's nothing in the Bay Area. None of you would have guessed that Oakland, which is really the Oakland MSA, would be at the far right. Right? Because any of you that are operating this market, you feel like on every corner in Oakland someone's talking about a new development. It's really not that pronounced as a percent of the stock here. So I personally, in Oakland, I feel like we can have a lot of new supply here because the market just hasn't been supplied over the last 40 years. So this is, if there's one takeaway, and this is the biggest thing we see impacting the business right now, is construction lending over the last 9 months has really reversed in the multifamily space. I talked earlier about a lot of the development we're involved with. We were typically getting high 60% range of construction debt as a percentage of our overall budgets for a development deal, and that's gone down to 55%, and for a lot of people it's down to 50%. Some of that is because of how banks now are being regulated and the kind of capital they have to have on book in order to do a construction loan. The other part is just where we are in the cycle, or in some cases it's just bank exposure to certain markets. With the new administration, that might loosen up a bit, but I would say this is the biggest thing impacting the multifamily development market. If you're an owner, that means it's going to be harder for new developers to add supply to your market. So it's actually it's a new barrier to entry, but it is impacting the market in terms of new development. Rent growth, this is just to give you a snapshot of what's going around in the whole country. I think some of the things you've seen here in the Bay Area in terms of rents tapering a bit, concessions coming into play, vacancies taking longer, we're seeing that across the whole country. That started probably the second quarter of 16. This is rents in 2016, and the Bay Area had a lot of its rent growth in 2012 through 15. So the last couple years, you look, Oakland is about 3% here, and I think San Francisco is actually less than 1%. That's technically what was recorded last year in the market, and the reason is those are net effective rents. That's after taking into account maybe some free rent or a concession. And it sounds low, but that's coming off numbers that were well into the teens for the prior few years. And this is just a point kind of about when you look statistically at the whole Bay Area where the peak was, actually when you had your highest net effective rents, that means, and you guys probably all remember this, you were leasing your units very, very quickly, you weren't offering any concessions, was probably summer of 2015. And so you still got great rents, you still have great occupancy, but you probably look back at that with things were a bit easy. I wanted to mention a couple things we're thinking about, and they're in some cases a little bit provocative, in some cases they don't impact you. I think Colin's going to be talking about a few of these things, but some of the newer issues, especially in the age of tech, of all the focus on technology. What you're doing about Airbnb? Are you allowing tenants to put a unit on Airbnb or not? What's that mean for an asset? What's it mean for security? What do you do about it? Autonomous cars. We have on new developments in office space and multifamily space, we're spending a lot of time thinking about our parking ratios. And do we need so much parking? And can we cut it back? In the more urban areas especially, parking is the most expensive, especially on a development deal that has a podium. It's one of the most expensive aspects of development. So can we pull that back? E-commerce. I don't know any of you that are owners, and are you dealing with tons of Amazon packages coming in? And where do those go? And do they disappear? And do you have liability associated with that? And if you don't provide a way for people to easily have their packages delivered, is that going to become a big negative in terms of someone not wanting to lease at your property? Pet ownership, smoking. These are things that when we think of environmentally friendly, these are things that people get very emotional about. Amenities, it's not so much in the Bay Area because we're so tight here, and the amenity becomes the Bay Area itself. But nationally, we call this the amenity war, and we have it in properties that we're developing in what I call path of growth markets, like a Charlotte or an Austin or a Dallas, where to differentiate your asset, you need to add a lot of bells and whistles. And if you haven't toured some of those assets around the country, it would blow your mind what's included. Like I've written up here, pet grooming stations and rock climbing walls and movie theaters and golf simulators, and it goes on and on. And if you don't do these things, you can't lease your asset. The other last thing, it's not technology related, but it is thinking when, as an owner or buying and selling, is tax policy. There has been some rumblings about changes with respect to 1031s. And that could have a very negative impact on the multifamily industry, especially at 100 units or below. It's just been thrown out there by the administration. I don't know what will happen, but I think if something does happen in that area, it will have a big impact on the residential space. So Doug, that's the...
Questions for David?
Yeah.
I have a question about amenities. So
Yeah.
what about Wi-Fi access? Is that an amenity that folks are looking for?
Yes. Yeah, and I know in our developments we've been putting Wi-Fi everywhere in the common areas as well as in units, and obviously then we've been reducing all the wiring that we used to put in buildings. So that's all coming out.
I had a question, and I hope maybe you can speak to it, but it may have been more for James. When you guys operate a lot of units underneath the view, you said something around 40,000+.
Yes.
So maybe this was kind of a smaller question James could allude to, but I think he stepped out. What are the 3 core competencies or like the top priorities you guys are looking for when you guys are onboarding new units for somebody to manage them? What are some of the things that you guys look for existing units in somebody that you're going to hand over once you guys either build and develop a new property or stuff that you guys already have?
So what do we look for in the unit or in the management company?
In the person you're going to hand over the units to, so the management company.
Yeah, actually, it's a good point. I do know that the teams, so we do a lot of lease-ups. Probably 95% of the new multifamily we develop, we participate in the investment of. It's development, and it's not existing product. So we buy, for every 20 deals we develop, we end up buying one. So on those development deals, we have a really good sense of when the units are going to deliver. We always have construction issues, but if we have a pretty good sense, we put different teams on lease-up properties than we do for once the asset's stabilized. So we, and there are firms nationally we use that will put teams in place for 6 or 9 months to deal with the lease-up. But on average, these are 250, 300 unit properties, so they're pretty large. So
do you think that there's a common theme of those competencies that somebody at that level is providing you as the property owner that might transition to a smaller guy?
The core competencies, it's more of a sales,
to help you lease up.
To lease up versus a tenant retention. It's different. The tenant retention, which is what most people are going to be dealing with, that's a long-term sales, right? That's customer service and thinking way ahead and 120 days out and that type of thing. Versus a lease up, it's just kind of what we say, get heads on beds, and then you deal with the first renewals when they come about.
Okay.
I don't know if that answers the question, but
Maybe
we do think of them differently.
When he comes back.
Yeah.
Thank you, David.
Yeah.
The slide that really stood out to me, you're right, Damien, just being here in Oakland, you see all the cranes, and it really does feel like there's a lot of supply coming, and that's a little bit unnerving as an owner, but it's interesting to see Oakland relative to our total supply, that it's actually a pretty small percentage nationally. Yeah, so that's good to see. Next speaker is my partner, Colin. So in our partnership, I'm like the real estate operations guy. He's the technology guy. He's really good at understanding the new technologies and how they're going to impact us in our personal lives and then also in business. And as you all know, real estate's a massive industry, has been somewhat technology averse. Technology is coming, and so Colin's going to share some ideas on things that we all may or all should be aware of.
Thanks. Okay. Nice to see you all here. Thanks for coming. I have a background in technology. I was an engineer, originally a robotics mechanical engineer, and first job out of college was at Boeing, doing research on automatic control systems on airplanes and writing algorithms using artificial intelligence, and that kind of gives you a little idea of where my mindset is. That's what I really love. My first startup was a software engineering consulting firm in the late 90s that I grew to about 35 people and then sold in 2000. And at that point, I had some money and began investing in a lot of different things. And I've invested very actively in the stock market. I've done a lot of angel investing. I've invested in over 50 startup companies, and I've invested in a lot of real estate. And I think hands down, the best risk-adjusted investment opportunity that's out there is residential real estate. So with that, I'm just going to talk a little bit about technology trends that are happening today and going forward, and then talk a little bit about how that relates to real estate investing. So we live in one of the most amazing times. We're at the transformation of humanity. 100 years ago, it took 5 days to get from London to New York. Global literacy was at 25%. Today it's at 86%. 100 years ago, only 6% of Americans graduated from high school. Today it's 80%. People didn't have refrigeration. Even as recent as the Clinton administration, a person living at the poverty line today has more access to information than President Clinton had during his presidency. 2016 was an amazing year. We discovered that there are 20 times more galaxies in the universe than we previously thought. We discovered 4 new elements in the periodic table. There are 118 elements now that we know of, and 4 of them were discovered in 2016. Renewable energy became cheaper than coal in 2016. We eradicated measles in 2016. And Google's AlphaGo AI beat the world champion in the game of Go, which, if you know this game, it's especially popular in China. It's vastly more complex than chess, and it was a real milestone because in 1997, IBM's Deep Blue beat Garry Kasparov, the world champion in chess, for the first time. But people thought Go was inconquerable by computers and would always have a human. Many people said that'll never fall to computers. And so, a lot of people look at what's happening with AI with both excitement and trepidation, including me. Whoops. So all of these changes are being driven by exponential growth. And it's hard for us as humans to really conceptualize exponential phenomenon. If we think linearly, we've evolved over 150,000 years. Like our minds don't change that quickly. And so, we're used to, if it took 30 steps to get to the river, and we've walked 10 steps, we can kind of judge, okay, that's 20 more to go. We get a good feel for that. But exponential growth is not intuitive to us. And so, as a result, it's hard for us to predict what's going to happen. And an example of that is if you take a step and then you double that and take 2 steps, and you double that and take 4 steps, in 30 doublings, how far will you get? Will you get to the river and back, or how far will you get? Well, you will get to the moon and back in 30 doublings. It's over 1 billion times, a factor of 1 billion. And so that kind of thing is just not something that we think about intuitively. And that's part of what makes kind of these phenomena that are growing according to Moore's Law. How many people have heard of Moore's Law? Some, not most. So, look, Moore's Law, this is a graph with an exponential scale here of the speed of microprocessors. Moore's law says that microprocessor power doubles every 18 months, and it's held true since 1965. And even going back before that to when there were early calculators and mechanical computing machines, all the way back to the year 1900, really. And it's continuing, and there always is a new technology just around the corner to allow the Moore's law to continue, despite people predicting that it only has another 10 years left, which they've been predicting for 40 years. And so this is an interesting chart which shows what's going to happen in the year 2023. That's going to be the year that a personal computer has the same computing power in terms of computations per second as the human brain. That's 2023. That's a little scary. More scary is what happens in the year 2050. That's the year when a personal computer will have the same computing power as the entire human race. Other things follow Moore's law. This is an exponential scale on the left. This is internet connectivity. Bandwidth just keeps doubling and doubling and doubling. The number of DNA base pair sequences that can be sequenced per day has more than doubled every year. So here's a quote I like from Yogi Berra. He says, "It's tough to make predictions, especially about the future." So, and I put that up because, we see this change is coming. We've all seen it in our own lifetimes, that change is happening faster and faster. And as investors in real estate or investors in anything, we want to create our view of the world, because to be able to invest well, if you know what everybody else knows, and you know it perfectly, but it's the same thing that everybody else knows, that information is already sort of priced into whatever you're investing in. The way that you can make money faster than others is if you have knowledge that others don't have. So if you can have your own perspective of what's going to happen that others don't have, that's our job as real estate investors. So now, for the rest of my talk, I'm going to talk more specifically about what are these technology changes that are coming and how do they relate to real estate investing. So I'm going to talk about 5 different technological changes. And the first one is 5G. So right now we're on the 4G data system for cell phones. And in 2 years, 5G is going to roll out everywhere. 5G is 10 times faster than 4G. The latency period, the period between when you make a request and it reaches its destination, is 1/10 of 4G. And it's going to support 100,000 connections per city block. So the cell phone makers are angling for 5G to be the kind of the backbone of data communication for the Internet of Things, which is the idea of devices being connected to the internet. So instead of just PCs and cell phones being connected, things like a lock on a front door or a toaster or a refrigerator will be connected to the internet and communicating. And so that's all coming really quickly in a couple years. And just one of the implications for real estate of that is that door locks are going to be connected. And so doing self-showings, which we do at Mind, we use, but it's not using the 5G network yet, but we're doing self-showings today. It makes things much more effective. But when we have front door locks that can be controlled electronically through the internet, we can easily do self-showings, and we can also allow vendors to access buildings. We can let the resident know, but they don't necessarily have to be home at the time that the vendor goes there. That's 5G. AI. We're at this tipping point with AI where specific jobs, we're still decades away from general intelligence, like the movie Ex Machina or Her. But we are at a point where for specific things like playing the game of Go, computer are better than humans. And that's going to be for more and more tasks that are sort of white-collar jobs. So the 1900s was like the century of manufacturing automation and the displacement of blue-collar jobs, but this is the century of displacement of white-collar jobs, and it's going to be largely because of AI. So from a real estate perspective, from a societal perspective, it's going to cause a lot of unemployment. There's going to be massive unemployment. Self-driving cars is just one example. So all the truck drivers and taxi drivers and Uber drivers now out there are not going to be driving cars anymore. And that's just the tip of the iceberg. But in every industry, in the insurance industry, the banking industry, more and more automation is going to replace human work. And it brings up really, big questions about society and what are all these unemployed people going to do. But from a real estate investing standpoint, how's that going to shift where people want to live? When we buy, I think for most people here, and certainly for me, when I'm buying residential real estate, it's a long-term game. I'm not expecting to sell that in less than 10 years, and I'm really thinking maybe never. I might own this for the rest of my life. So that's a long time with regard to looking at how are these these changes that are coming faster and faster going to change society. So if we can figure out where can we get, where are places going to lease faster? Where are people going to pay more for rent? Where do people want to be? And so thinking about this shift where, driven by AI, where there are a small number of people who become richer and richer, like the Mark Zuckerbergs of the world, and then there are a lot of the working people who are now struggling to find employment. Related to AI is self-driving cars. I was at a conference recently where the chief product officer of Uber spoke, Jeff Holden, and he said that we're only 2 years away from the first completely autonomous Uber rides starting to happen, where there's no driver behind the wheel at all. You just have a car showing up with nobody in it. He said it'll be slow at first. It'll only be 0.1% of all the rides, where the weather has to be right and the route has to be right, and they'll be testing it out. But very quickly, it's going to become half the rides and then all the rides. So what's that going to do? One thing it's going to do is it's going to reduce traffic. We're going to go, so many people feel that, and I'm included, once there are self-driving cars, people aren't going to own cars anymore. The cost of an Uber ride is going to drop dramatically. Jeff Holden, the chief product officer of Uber, said the cost of just using an Uber all the time will be 1/10 the cost of owning a car. So if that happens, we're going to go to a society where nobody owns cars. And the cars that are out there driving are going to be driving all the time. There's going to be no need for parking. Traffic's going to be much more efficient because most traffic inefficiencies are caused by human inefficiencies. And so one theory about this is that people are going to be more willing to drive longer because they won't mind, because they won't actually be having to drive. They'll be getting a ride, and maybe that's nicer. Maybe they could work on their computer and make use of that time. So some people have the theory that that'll make people more willing to live further out. It might have, we might be thinking about buying a multifamily building because it's close to a muni bus stop. Well, when there's inexpensive Uber available to everybody, it's like public transportation is everywhere, and being close to a bus stop might not be as important. And then I think the biggest change resulting from self-driving cars is the parking, the physical parking itself. There's going to be no need for parking. Parking is going to go away. Those Uber cars are going to be driving all the time, and maybe in the middle of the night when they're not driving, they'll be parked somewhere out where there's lots of cheap space. They don't need to be parked anywhere close to the urban core. So within the urban core, there will be no parking. And so think of all the parking structures. And it could be for a building in San Francisco, a 12-unit apartment building where there's 12 parking spaces on the ground floor. Now San Francisco is lowering their parking requirements, and those will ultimately go away altogether. And those spaces are now being transformed into rental units. So that's one perspective on that. Neighborhoods will change. Maybe neighborhoods that are the most heavily impacted by a parking shortage, and that's viewed as a real negative, that's holding rents down in that maybe, or, keeping rents from really skyrocketing in that neighborhood. When nobody cares about parking, maybe that neighborhood becomes even more desirable. So everyone hopefully is kind of creating their own view of the future and thinking about these kinds of things and incorporating them into their investment decisions. How am I doing for time?
Getting close. I started
over. Okay, cool. So I've got two more things I'm going to talk about, then I'll be done. One is global connectivity. So today, still fewer than half of all people on this planet have internet access, but we're just about at the 50% level right now. But most of that internet access is not high speed. But 5 years from now, 90% of the people or more on the planet will not only have internet access, but it will be very high-speed internet access. So two different satellite systems are going up now that are going to provide high-speed internet access anywhere. And so when you go from really, with high-speed internet today, it's still just a fraction of the global population to the entire global population having high-speed internet access, and they also have access to free education. So things like Khan Academy and Coursera, where you have high-quality Cal and Stanford and MIT courses available for free. This is like for a poor person growing up in Bangladesh, this is life-changing. And so suddenly, like the whole phenomenon that started, I think, becoming talked about a lot in 2000 of the world is flat, and we're suddenly competing for jobs, outsourcing jobs to India and Russia and other places, China. That phenomenon has taken a big leap forward as internet connectivity speeds have doubled and doubled and doubled and doubled. And now at Mind, we have 10 engineers who are in Russia and Ukraine who connect every day on a big screen TV like this. We'll be in a meeting, and it's like they're right there. It's high definition video, real time. It's just like they're right there in the room together. And I think this is so implications for real estate of this are it's going to be a much more global workforce, a much more level playing field, which is not great for Americans who make a much higher wage than people elsewhere in the world. And there's going to be a big trend towards being able to work from anywhere. And already you see this in the corporate workplace. Even Mark Zuckerberg at Facebook, he spends every Wednesday working from home. And then the last one is medical. So people are living longer and longer. We've just there was the first transplant of a rib cage that was 3D printed in the last couple years. Stem cells are being used as brain cells in mice and dramatically rejuvenating these mice. We're printing DNA. We're doing gene editing to reprogram T cells to not attack the body's own cells, but to attack cancer cells by splicing out sections of the T cell's DNA and splicing in different DNA. We have 2 likely cures for HIV and AIDS. And this is the beginning of what's already been happening, which is people are living longer and longer. And so what's going to happen when the percentage of people living over 85 doubles and then doubles again within the next 20 years? So, and how is that going to affect real estate? And where are those people going to want to live? And what kind of housing are they going to want to live in? All right, so with that, I guess we have time for a couple questions. Yeah? Any question or no? Yes?
So your speech actually comports to singularity. That's you gave the same thing from Wolfwall.
Yeah.
Linear versus exponential. So in summarizing what you're saying, it sounds to me as though commercial workspaces will be less relevant, but residential will be much more needed if we're going to be living longer, but then not needing to come to work because we can work from anywhere.
Yeah,
The idea of automated cars, right? That's sort of like when I was growing up, you had a guy in the elevator, driving the elevator. So the same thing. It's not such a far leap to believe in what you're saying. And then the other side is that all the parking lots, all the parking features, those all become essentially residential space available.
Yeah.
Since we're not going to work, they'll be living spaces, correct?
Yeah, that's right. That's all true. I think so. Yep.
Yeah.
Good. All right.
Thanks.
Last one. Yep.
So does mine have in its path, in its business plan, to have AI for tenant screening?
Yes. That's not to say that there wouldn't still be a human involved in also checking what's being done, but to have more and more intelligent algorithms around screening, absolutely. But always with fair housing laws in mind.
And I would say that, to answer your question, it's actually already happening today. I mean, typically what most people look at is FICO and income, and one of the things that we learned at Waypoint is there's data available that actually looks at the composition of a FICO score, and the composition of the FICO score, if you look at it properly, can actually tell you more about someone's behavior than the FICO score itself. So as we evaluate people, we're not simply looking at income and FICO, we're looking at the composition of if something's late, how late, what type of bill was it, and we use that information to help us qualify people, and that's just going to get more and more sophisticated as time goes by.
Well, the human component, I'm a landlord, and looking somebody in the eye and talking to them for 10 minutes is worth as much as a piece of paper.
Would you like to address that, Doug?
Yeah, I mean, I would say that I myself, oftentimes feel like I have a pretty good gut feeling for people, but I also, in hindsight, have realized I'm wrong. And, people have all kinds of implicit biases that they don't even know exist, and it's, I think, a little bit risky and dangerous to rely 100% on that. That doesn't mean that meeting someone and having them show up on time and seeing how they show up isn't also an important part of the process, but assessing the data is also really, really important. So I don't think you're wrong. I think it's a combination of the both.
I didn't say 100% rely on it.
Yeah, no, it's important, but I just also know how far I trust myself in terms of my gut feel.
In the Oakland market, have you looked at the things that make people decide which apartments they want to rent? And what are the elements? I'm not talking about price specifically, because we know that that's a deciding factor. But what other elements have a real heavy weight in where they choose to live?
Yeah, so, I mean, this is a great question and something that we're going to study more. And at the end of the day, you have to gather a lot of data. So I don't have the answers to those questions yet, but
I can give you a couple off the top of my head that we get a lot. Pet friendly, 40% plus of people looking for apartments are looking for places that are pet friendly. And then public transport, particularly in Oakland, close to public transportation. Those are the two biggest ones.
yeah, I'd say just, the general things people care about: location, they like nice kitchens, they don't want to be in an area where there's too much crime. But this is the type of information that we're going to be tracking and trying to be able to do a really good job of predicting.
To put a number behind some of these things is like the next advanced step that I'm very curious about. Helen would be, you'd be thinking about.
Yeah, that's on our roadmap. Is to create. Yeah, we're looking at creating an automated valuation model for predicting rents on multifamily that takes into account all of the things Doug mentioned, as well as does it have Formica or granite counters and everything like that.
And I'm actually going to tell a little bit about the Waypoint story, our prior experience, but it was pretty interesting. In the single-family rental market, there is very, very little data that helps you pick a rent, and we actually created the first single-family rent optimization algorithm, and so we had our own system that looked at a lot of different data, and it did a pretty good job, and it was getting better and better at predicting what the actual rent that was going to move the asset for. So with that, I want to be respectful of your time, and I'm the last presenter, so that's good news. So what I'm going to talk a little bit about is our last startup, Waypoint Homes. It was during the foreclosure crisis. It was a very, very interesting experience, and there's a few lessons that we learned that we think could be beneficial to all of you. And then I also want to leave you with 3 tips that I know I'm an investor myself, and these are technological advancements that I know can help you improve the performance of your asset. So Waypoint Homes was the name of our last company. Really, so 2008, I was in the apartment business. I spent the early part of my career, actually started out as an NFL place kicker, part-time investor in real estate, but focused on large apartment buildings. And when I retired in 2005, I continued to focus on buying large apartment buildings. But I noticed in 2008, here in the Bay Area, as the prices of homes started to fall precipitously and rents were staying pretty flat, I started to ask myself the question, why am I chasing apartment buildings when they're practically giving these houses away, and the cash-on-cash returns on those houses are really, really compelling? And so that's where Colin and I connected. We were both in an angel investing group together. We were both kind of asking the same question. We decided to investigate. We talked to a lot of real estate experts. The resounding answer was it was a terrible idea to go buy a lot of single-family homes. It was the sky is falling, prices might never come back. You don't want to catch a falling knife. Even if you do manage to buy a lot of properties, how are you ever going to manage them? It's going to be an operational nightmare. These houses are spread out all over the place. So we absorbed all that feedback. At the same time, we were kicking the tires. We were out looking at houses, bringing contractors out, really trying to understand what the rents were, making lots of offers, literally walking away from houses that were $60,000 over like a $2,000 discrepancy with the bank. But finally, what we ultimately decided was that the biggest risk was to do nothing. You guys all probably are familiar with these pictures. These were littered all over the far East Bay. We ultimately decided to pull the trigger and buy a house. So this was the first house we bought. It was on Maple Street in downtown Pittsburgh. It was a 3-bedroom, 1-bath, just under 1,000 feet. Guess what this house sold for at the market peak in like 2007? Downtown Pittsburgh. $410,000 was what it sold for at the peak. Guess what we bought it for? $65,000. Put $20,000 into it and rented it for $1,500. I mean, who wouldn't just keep doing that? And so we ultimately decided to keep doing it. And so what we did is we raised a lot of high net worth money. We ultimately raised the first institutional capital in the space from the Columbia University Endowment, and then ultimately did a deal with Barry Sternlicht and Starwood Capital and created a single-family dedicated REIT. Over that time period, we bought 17,000 single-family homes. It was about $3.5 billion worth of homes, and built up a vertically integrated management company. We did everything from buying the properties, construction management, leasing, property management, about 550 people total. And the thing that we were by far the most proud of, it goes back to those questions from those expert investors who said, you'll never be able to manage all these homes. Well, what we ended up doing was building our own technology platform that we called the Waypoint Compass. And that technology platform gave us a lot of visibility into our operations. We tracked all the data, we set up dashboards, we measured what was happening with every house and every market. And that visibility gave our management team the ability to manage these homes to the same NOI margins as large apartment buildings trade at. So with 17,000 homes in 13 markets, we were reporting publicly NOI margins that were between 62 and 65%, which are on par with large apartment buildings. Yeah. Pretty similar. So what that told us is that there was a way to build technology to manage all the operational complexity, which is very, very true in single-family homes and still somewhat true in small multifamily buildings that are 10, 20, 30 units. So, I mean, obviously over a 7.5-year period, we learned a ton. I think there's 2 things that stand out in my mind that would be relevant to all of you. So the first is this idea of first principle investing. You may have seen Elon Musk talks about it all the time. And the idea of first principle thinking is thinking of what the things that you know to be true, right? So in 2008, I mean, the sky was falling, right? Nobody wanted to buy single-family homes. A lot of anecdotal, emotional information that was presented to us. But what we realized was there was a handful of things that we knew to be true, and we anchored on those things that we knew to be true, and it was convincing enough for us to pull the trigger. So the first thing we knew was we were buying these houses at less than 50% of the cost of construction. So we knew that prices would have to roughly double to start building. We also had a lot of confidence in the San Francisco Bay Area job market. So we figured at some point jobs will start being created, we're going to need more housing, we're going to have to build, prices are going to have to go up for that to happen. We also knew that we could lock in long-term debt, and that at the price we were buying at, even if rents softened, we were still going to have 10% plus cash-on-cash return. So we looked at it and said, even if we're totally wrong on the values, we can hold these things long enough, and we're still going to have a compelling enough cash flow, and we were comfortable with that. And then this is something that Colin saw, and it was really in response to the question around how are you going to manage these assets. Mobile computing and cloud computing were brand new. And what we really needed to build was a relational database that could help us organize all this information, but for that information to be real time for our teams in the field, and for them to be able to be doing things out of the houses and putting data into the system, and on a real time basis, all the dashboards and metrics are updating. That system didn't exist, but we knew because of those he knew because of these technologies that we could build something to solve that problem. So that is something that I think, as you look at investment opportunities, it's, what are the things that you know to be true? There's always a lot of people with emotions and anecdotes, and those can be confusing. Invest on what you know to be true. Technology will transform real estate. Like, we absolutely believe this. It's not a matter of if, it's when, who, and at what pace. There's just way too many. We had a real need with all those single-family homes to leverage technology and systems. We saw this stuff work, so we know this is going to happen. And I think it behooves all of us to understand these changes so that we can make sure that we stay in front of them. This is a quote that I love. It's a sports quote, but I think it's very germane to what we're trying to talk about today, which is, so this is Wayne Gretzky: skate to where the puck is going, not where it's been. And I think today in real estate, it's really, really important to try to forecast out what's going to happen and how can we position ourselves to be successful. So with that in mind, I want to leave you with 3 tips, 3 things to just be aware of, and it's up to all of you to decide how to apply it to your own portfolio. Data is going to be big. In the last 2 years, of all the data that's ever been captured and stored, 90% of the data we have has been captured in the last 2 years. And so that just shows there's this mountain of data that's being collected, and a lot of industries, frankly, are doing a much better job than we are in real estate, but that data is going to become extremely useful. So I thought I'd share this. So this was my workout yesterday morning. I don't know if you've ever done any of those spin classes where they put the big monitors up on the in front of everybody, so you can literally see all this real-time feedback on how you're doing. It actually ends up giving you a tremendous workout because you're always pushing yourself and measuring yourself, and I felt pretty good about it, but I actually went to the gym with a guy who's a Ironman triathlete, and he killed me, and it was like very, very apparent that he was beating me. So in this case, this was too much data, but this is the fitness industry, right? Like, all this data is being captured. I always think this is super interesting. If you think about any asset class and you think of who are the smartest, most successful investors, and what do these people have in common besides being billionaires? They all want data. They want data, and they want the most real-time data possible, because with that data, they make better decisions that enhance their returns. And so Barry was our chairman. He's the guy in the bottom left, and he always wanted to know, what's the data behind the story you're telling? I don't care about the story. Let's talk about the data. And ideally in the palm of my hand, right? Like, a lot with most asset classes, if you own stocks, you own bonds, you can go online anytime, see exactly what's happening. There's no surprise when you get the letter in the mail that tells you the performance of your stocks. You could have seen every single day what's actually happening. So one of the questions that Colin and I have asked ourselves, we've live this existence at Waypoint, but we own these investments on our own and have hired and fired property managers. It's this question of why does this industry live in somewhat of a data desert? There just isn't a lot of data available. A few people have told me people have been investing the same way for a long time. It's worked. They're just not really interested in data. And I don't think that that's true. I think that data is going to start to be captured. That data is going to be extremely valuable, and people are going to use it to make more money. And at the end of the day, everybody who's buying properties, we're trying to make money, right? So we want to be as smart as we possibly can. So some ways that this data can make us really smart. So I talked about it in the context of Waypoint. Dashboards and metrics, super, super powerful. What exactly is happening at every life cycle of the investment? If you know what's happening, you can deal with issues, you can make decisions. Revenue management. Do I want to do a 9-month lease at a rent of X or a 13-month lease at a rent of Y? Depends on the time of the year, seasonality, different factors. There's revenue management systems that Damien's company uses for those big apartment buildings. We don't have the benefit of that with our 10, 20, and 30 unit buildings. Rent optimization. There should be an algorithm that tells us based on certain factors, this is the rent that you should use today. This information will come. Capital improvements. I have $10,000 that I can put into my unit that's turning. What should I do? Should I put in a new kitchen with stainless steel? Should I add a second bedroom? Data can tell you what you should do in those circumstances. Predictive analytics. What's my building's run rate going to be at? In the future, and we got pretty close at Waypoint, if we knew the vintage, the year that the asset was built, the location, certain aspects about that asset, we could come pretty close to predicting what's the vacancy going to be, what's the operating cost in terms of repairs and maintenance in turn. We could come pretty close to estimating what that was. With more data, we can start to be a lot more accurate, which is going to make us be able to benchmark ourselves and our performance and help us decide what to buy. So data, it's coming, get in front of it, get as much of it as you possibly can. Tip number 2. So technology is going to make leasing more efficient and reduce vacancy. So we've all been leasing in the Bay Area, and I think James talked about it. It's been pretty easy. The rental market's been really, really good. Things have softened. Things are getting a little bit harder. I think that this is going to make the efficiency with which you lease start to become really, really important. So here are some things to consider. At Waypoint, we were reporting publicly how we leased and what we leased for really, really moved the needle on our financial reporting. And so this is something we study a lot. Syndicated marketing. I hear a lot of people say, I list my property on Craigslist. Craigslist is one place to market. What you really want to do, there's a platform called RentLinks. It's basically a marketing syndication platform. It'll put your listing out on all the most relevant marketing sites out there in the market. And by the way, that's a different answer in every single market. So you want to cast a wide net. You want to have as good of an online presence as possible. Professional photos drive 60% more traffic. There's 3D tours. So these bottom 2 pictures are actual 3D tours. We use these. The bottom picture is a view of an actual unit. This is my building down on Jackson Street. Someone can see what the unit looks like. In the picture above, you can actually walk through the unit, look in the bathroom, you can place furniture, move it around. People actually lease units just doing a 3D tour. The more information that you can give them online, the more they're going to hang in there to take that next step, which, by the way, the next step is where we saw the biggest fall off. Okay, so I want to see that unit. Well, in the old days, you had to meet the leasing person there. They'd show up and you had to schedule something with them. And if it was just too hard to schedule, you just called the next building, right? That's what people do. If you don't get back to them within 5 minutes, you're going to lose them. So what we do is we set up a calendar. They can basically go on a calendar, pick a 2-hour period of time that works for them. They get a unique code. They go through a screening so we know who they are. They can go see that unit using one of those smart locks that Colin talked about. Get in the unit. They have to send us a code when they get there so we know they're there and our team is texting them or calling them or whatever. But the point is they can quickly and efficiently and conveniently go see a unit without a salesperson breathing down their neck. This is actually what people want. We saw huge improvements in our vacancy and the rents we were achieving when we rolled this out. So self-showings are really important. Talked about this before. resident screening using predictive analytics. There's a lot of data out there, more and more. Use it to screen who your people are. The data tells a very, very important story. And then mobile-enabled leasing. I mean, the people that you typically want leasing your building, they're on phones, they want to lease in a mobily enabled way. If you can take them through the entire process on a phone, it's really seamless, easy, and you're going to get more leasing traction. These are some companies out there that we know of and we use. So CodeBox and Rently have their smart lock boxes. Matterport and Inside Maps, they do these 3D tours that are really, really cool. Parakeet's got a cool software program for managing smart locks, and then of course we're rolling all this stuff out into the property management space. Last tip. So this is really basic, but communications in property management, it's the blocking and tackling. If you don't get your communication right, you just really don't have a chance. And it's interesting because a lot of communication in property management is so manual and it's not tracked. So 21st century case management exists now. There's a really cool company called Zendesk, and what true case management is every conversation has a number, and it can be referenced via an individual in a unit, and what that means is every single conversation can be tracked, and that thread can be looked up if there's ever an issue. And so what having a 21st century case management system allows you to do is to better manage these communications and make sure that everything's tracked. So when you have the he said, she said situation, you can very clearly go back and see timestamps, dates, exactly what we said, the fact that we called you 3 times and you never called back. It ends those conversations pretty quickly, and then when you get called in front of a rent board or have some kind of a claim, everything's in writing. So we're using a robust case management system, and for communications to happen, it has to be in writing. We don't do it if it's not in writing, and it's really just to make sure that communication is clear and everything is tracked so we don't have problems later on. And so however you're communicating, I think if you think about the city of Oakland and San Francisco and really the Bay Area in general, it's not going to become more landlord friendly. Right? So that means you got to cover your butt. And that means you got to make sure that you're tracking your communications. And so I would highly encourage you to get out in front of that. So just to close here, these are some ideas that I'm throwing out there. Colin and I are putting our money where our mouth is and voting with our feet and actually trying to build a company around this. And, part of it is we're both landlords ourselves, and we've had bad property management companies, and we fired them, and I've self-managed a building, and I have better things to do with my time. And we just felt like we know so much about how this can be done in a more efficient way. We made a lot of money for Wall Street investors, and that's fine and good, but what we'd rather do is make money for individual investors like yourselves, the people who own a couple houses or 10 units or 20-unit building. And so we're building a company that is really fundamentally just trying to make this more simple. And we don't think that managing and owning properties needs to be so hard. And you should be able to do it from anywhere, because if you have access to the data and you can see what's happening, you do not need to go see your property every day. And it's probably highly unlikely that the best investment's always going to be in your backyard. Sometimes it's in Dallas or Cincinnati or somewhere else, right? So we are building this company, and really fundamentally it's about transparency. And if we are building our own operating system, it's going to allow us to capture a lot of data. It's going to allow us to give owners transparency as if you had a stock or a bond into what's happening with your portfolio, and understand all kinds of other important tasks and status reports of things that's happening. So we are trying to eliminate the black box of property management, which has frankly frustrated us for a long, long time. And what it comes down to is leveraging technology, data, and systems to make people more effective. So sometimes we get asked well, I'm not, comfortable with a bunch of computers managing my property. And our answer is, look, managing properties is operationally complex. And there's always going to be people that need to do those tasks. However, If you build a really good team of people and you equip them with the right data and systems and tools, they can do a far, far more efficient job of managing their property, making it more profitable. And see the smile on this guy's face? I mean, this is what the company is named after. We want to create peace of mind for people who own properties. And that means your property is profitable, it's being well managed, you're confident that it's being taken care of, and frankly, you can see what's happening at any time, and that gives people peace of mind. So it's really about an owner experience and a more profitable investment. And so that is the end of the presentation, and I'd be happy to answer any questions.
That's amazing.